Management fees are like heroin. Once you get addicted to them, it's impossible to stop.
There's vanishingly few venture managers in Canada that are ever going to reach their carry. It's less than 10%.
So we are overgranted and undercapitalized.
How do we get entrepreneurial thinking out of the brain and into action so that we have the right people helping the right companies be successful?
So I wanted to host this panel because I had been having this conversation about government funding a lot privately. And I found that everyone has a lot of opinions privately, but publicly everyone was afraid to talk about government funding and its pervasiveness or how it should be applied, and no one wanted to speak about it. And I think it's because there's so much fucking government money in the system, and everyone kind of gets a little bit of it some way, somehow. And so everyone's kind of afraid to ruin the payday. And so what I wanted to do is assemble this incredible panel as a spot where we can all kind of share our opinions about what's going on in government funding, and it's a safe space, hopefully. Maybe not, actually. But so we're going to talk about it. And in the spirit of sort of sharing our opinions about government funding, I'm going to share mine to start, which I took to LinkedIn about a month ago to share this opinion, which was kind of my first time of like, I'd spoken a lot about it privately, and I was finally like, okay, let's do it. And what I wrote is that government funding in the tech ecosystem is kind of like water to a houseplant, where it's essential a little bit every week. The plant will grow, it will flourish, but too much and you'll have root rot and the plant will die. And I made the analogy that right now the house is flooded. And so its pervasiveness shows up in three main ways: in government grants, in venture capital, and finally in sort of nonprofit ecosystem support organizations. And so how that goes is, from the government grant perspective, you can go to IRAP, you can go to Alberta Innovates, and you can get funding, and essentially you'll be funded to the tune of like $500,000 in a lot of cases to hire a team of 5 people to build a product when you have no revenue in market. And so I think where that becomes perverse is you can spend about 8 months shifting your company to getting some of these funds while not talking to customers, because it seems like really attractive revenue is this government grants. And then if you get it, you get to hire a team of 5 people, but you still don't have real revenue. And then on the other side, you have a company who has real revenue, but now can't compete for talent because you have $500,000 and no revenue, but you can hire a team of 5 people at above market rates. And so it actually becomes anti-competitive as well. And so I think that's one of the reasons why it slows down our ecosystem. At the next level is the VC level, where BDC has become an LP in about 67% of all LPs. And so what it does is it creates sort of a risk aversion from a BDC lens. And then finally at the bottom, you have a bit this prison of our own creation that we've made, and then the Canadian government funds about 400 different accelerators and incubators to walk founders through that system of going to go get grants and then go get VC and sort of walk through that whole system. And so that's the claim I made, and I said that all this government money has skewed the incentive programs in Canadian tech. I made that case. That was my opinion. It's still kind of my opinion. And so what I want these people to do is tell me where I'm right, where I'm wrong, and what I'm missing. And I think I've assembled all the right people to do that. And maybe I'll let you guys introduce yourselves. So Derrick, I'll start with you.
Okay. My name is Derrick Hunter. I'm the CEO of Bluesky Equities, which is a local, my team calls us a family office. I prefer private, unconstrained investment management company. We invest in a lot of startups, and I also chair the Hunter Hub for Entrepreneurial Thinking at the University of Calgary.
Hey everybody, I'm Graeme Harrison, I'm managing partner of Augur VC, pre-seed and seed stage allocator with an office here and in San Francisco. 2 funds investing primarily in AI infrastructure as a vertical.
I have one.
Wow.
I brought my own.
You're prepared.
I know. Does it work? Can you guys hear me? Excellent. Okay. I'm Michelle Scarborough. I'm an entrepreneur and an investor. I've spent the last 25 years in venture capital in Canada and the United States. My last role at BDC. I think we are going to have a little chat about that. But at BDC, managing about $750 million of AUM, investing in women-led technology companies in Canada, and subsequent women-led funds in the country. So we'll have a lot to share on that, I think. But I'm coming out of sabbatical right now and thinking about what I want to be when I grow up. So if there's nothing that shows you that on the screen, we can talk afterwards.
So Cam Linke, I'm the CEO of AMI, the Alberta Machine Intelligence Institute. We're one of Canada's 3 national centers of excellence in artificial intelligence.
Okay, amazing. This is awesome. I think maybe there's a little bit more framing I want to do, just a smidge, in the sense that right now there's a big fight from the two sides, two factions of the kind of venture capital lens, which is NACO and the CVCA, which is NACO saying we need $750 million deployed at early stages, and CVCA saying we need this at Series B+. As well as Alberta, the government of Alberta this week just announced the Alberta Technology Innovation Strategy, which says that now Alberta Enterprise Corp and Alberta Innovates can now do direct investing into companies instead of just as LPs into funds. So there's a lot of policy decisions being made actively. Often it looks like more government funding going into the space. And so what I wanted to do is I wanted to break down my argument from the grants, VC, and then the nonprofit ESO perspectives. And so maybe I'll start with you, Derrick. You're maybe the most active seed investor in Calgary.
We'd be one of them for sure. Yeah.
One of them. Do you see founders becoming stronger, leveraging some of these non-dilutive fundings, or are some companies just optimizing for grants?
There's so much to unpack in all this. And you'd have to start with the CVCA NACO thing, because I wrote a piece in the Hub 2 weeks ago about this, and I kind of laid out my opinions there. I'm conflicted like crazy because I'm also on the board of Alberta Enterprise Corp, which you just alluded to. I have been for a long time. And I would say a couple of things. One is that, the company I lead, we've been probably the most active seed investor in Alberta, I would think, in the last 10 years. We've invested in over 100 startup companies, and about half of them are Alberta-based, so, quite a lot. Why? We start from the premise that all economic opportunity comes through entrepreneurship. If you want to grow economic opportunity, you have to have more entrepreneurs. It's really that simple. And the more you start, the more, you'll ultimately have growing entrepreneurs and scaling and all that sort of thing. So I'm certainly not opposed to elements within, the government has a role to play. The government created the internet, in the United States. The government created AMI. I'm never going to say that's not important. There's a role to play, but ultimately, it should be, if you want a healthy economy, you need entrepreneurs. If you want the growth of those and the financing of those companies to be effective, it should be private sector led. And we have a severe shortage of private capital in this country, and that's what concerns me. And I've probably evangelized on this topic more than anybody in Alberta. I've spoken to many audiences, high net worth audiences, trying to encourage them to do what we do. We've proven that you can produce acceptable returns as a venture investor in Alberta. We don't knock the cover off the ball, but we do an adequate to justify the risk. So it can be done. And I've proven this, and I've shared our data many times. But it's very difficult to get people to jump into the pool. And there's a lot of reasons for that. This isn't the question you asked, but after you pay income tax on your income, the money that's left over is capital. Why don't we invest our capital in startups? And a big part of the reason is because there isn't very much of it. Once the government extracts, you're at a 50% tax rate at about $200,000 in this country, there is no capital. So I don't begrudge founders doing what they're always told to do in this country, which is to go around and ask for vouchers and grants and IRAP and all the rest of it. I mean, these things are set up. It'd be foolish not to take advantage of them. But if we really want to produce, our share of successful entrepreneurs, you need private capital. right? And we can get into the reasons why there's not more of it, but ultimately, that's the fundamental problem.
Yeah. Cam, I want to go to you. You're on record in the parliament as saying that we're over-granted. What was the quote? Do you remember?
I said we were over-granted and undercapitalized.
Over-granted and undercapitalized. Well, what's your kind of take on grants? Obviously, like Amy is a huge supporter. In fact, I had a call with someone today, Casey from Atero Labs, who said that Amy was one of the most incredible ecosystem supporters there is. 2 for 2. And so what is your take on kind of the government grants in the space?
Yeah, so maybe I'll back up and say, why do grants exist in the first place are typically to fill some sort of like market failure. So you might say, right now there's no capital in the ecosystem, and a U.S. venture fund could come in and just take out 100% of a start, but give them terrible terms for $500,000, and we don't want that to happen in Canada. So we'll have a grant to be able to get them through that stage, so they don't have to take that check. Maybe it's like a market failure that we want to try and solve with a grant. I'm not saying that's the right way to do it, but just that's the kind of theory. And so, we grant the public school system because there isn't a private market, or private companies aren't necessarily incentivized just to train all of our children in the province or in the country. We do this at multiple stages for multiple things.
And
we
train
do
them
this
on AI, right?
on train or in general. In general, we like grants or like government should step into a place or can step into a place where there's a market failure to try and fill it. So in theory, this can be a good thing. Whether it's helping something get to market a little bit faster or fill an area around training that may not exist. These are all, I think, potentially positive things. The challenge is, I think, one, that we don't actually review the programs very well that we have out there, or we misalign incentives. And so what ends up happening is we put more and more grants into a system with incentive misalignment. So like as an investor, I actually would love to have no employees in a company because they're all just painful, and have like that all go to my exit. This is great. Whereas the government wants to have all employees in the company when they're putting money in. So you're completely misaligned on incentives. And so we've stacked grant program after grant program after grant program around metrics that are actually not really aligned with venture outcomes and venture success. Whereas while not necessarily perfect, venture typically has a very aligned thing, or should have a very aligned thing. The entrepreneur has a successful company, and I get a return from that investment that I made. And so it might not be the perfect alignment, but it's a much better alignment than I put in money and now I get yelled at by my boss if that company fails, because my grant program's supposed to be keeping them alive to have more and more people employed. And so that's just ended up having programs that maybe all were well-meaning to start, fill our ecosystem with grants, rather than have venture or more venture-backed system that goes, here's your dollar, go either get a customer or get enough traction together, get another dollar, or die, which is totally fine, and have that talent and those people recycled back into the community. Instead, we have misaligned things where grants just gotta keep people alive forever.
Right.
Like companies, not people. People are good to keep alive.
It strikes me like that's a big part that we're not really talking about is like we've almost artificially lengthened the feedback loops that are necessary in startup creation, right? Like if I'm building a startup, I want to learn what the customer needs as quickly as possible. If it's 3 times a day and I want to iterate, and we've taken that 3 times a day, so like even like 0.3% of a day, that startups should be kind of iterating, especially at like that pre-seed early stage, and said, why don't you take 8 months to do that first iteration cycle as you apply for your first grant? Or BDC, their pre-seed checks, I think they say 8 weeks, but in reality, it often comes like 12 weeks to do due diligence at the pre-seed stage in Canada, which that's a quarter of the year you're spent waiting for a pre-seed check, instead of like in the US, you probably could not leave a meeting without getting a check, or if not, it would take you a week, right? Before we fully go on to the VC side, because I think that you guys are all going to have a bit more to say about that. Graeme, I'm curious your take as a VC. What happens when some of your companies are considering non-dilutive funding, and what's your take on the grant system in general?
So generally speaking, I would just tell them not to bother wasting their time. You know, the amount of times you can talk to a customer, that's the only thing that really is valuable when you're at the pre-seed stage, is going and doing customer discovery. If you look at pace of play in San Francisco, companies in Y Combinator, they're there for 6 weeks. You know, day by day, they track their revenue growth. The idea that you could spend 8 months applying for a grant is just so off the competitive meta. There's no point in doing it. If you waste your time doing that, you'll probably die as a business before you find out even if you're going to get the grant or not. If a company that we invested in was asking us, shit, should we go, talk to more customers or go spend however many hours going for a grant? I mean, I would already say, why did I invest in you in the first place?
Yeah, okay, fair enough. Do you have a quick response to that, Cam? Or Cam, I know you had said that there's a difference between research grants and company grants.
Yeah, I don't really feel like I have an answer to that. I would say for the most part, that's right. You should look at it. And I do think there's some granting programs that are at least well known for taking less time. And if they're helpful, go for them. But the number of programs that we've seen that start to dig in, go like, why am I spending this amount of time for $15,000? This is insane. And yeah, you're 100% right. It's not worth it. I do think again, like there's a difference between granting for investments in science and stuff like this, and research, and like the grant ecosystem that we've created around startups. I think those are kind of two different things.
Yeah. Okay, let's shift to the VC side of the world. Michelle, this is where you shine. This is your section. Michelle, you spent 8 years at BDC. You still have 2 major funds there. You left in July. Since you left, BDC has written down their portfolio by $220 million, which is a significant write-down. And I made the argument that all of venture capital in Canada is dependent on BDC. But BDC itself is struggling. What am I missing, and what's going on the inside of BDC? Or I suppose you can take that question any way you want if you don't really want to answer that.
Not sure I'm going to answer that part.
Yeah, exactly.
Well, first of all, I think if you look across the VC landscape, you'll see pretty much everybody writing down, unless they're messing with their numbers a little bit. The venture capital ecosystem has not performed well. I mean, Derrick alluded to this. Well, you didn't allude to it. You said it outright in your blog, in your post. But the venture capital marketplace has not done well from a returns perspective for a long time. There are blips on the radar. You see Cohere go. You saw Xanadu, if anybody knows about the Xanadu story, doing a SPAC on the NASDAQ. This was like a month ago. So there are blips on the radar where we've got some companies in Canada that are doing very, very well, but overall returns are sitting at around 1.1, 1.2 times MOIC. That's not great.
And do you want to explain MOIC before
so
we move
just
on?
think cash on cash returns. So you put $1 in, you want to get at least your $1 back. So in venture capital terms, you want to put $1 in and you want to get $10 back. That's typically how it works. But many of the venture capital funds in the country have been historically doing 1-to-1. So I put $1 in, I get $1 back. Maybe I get $2 back.
And it's not just that, right? It's like I put $1 in, I wait 10 years, and then I get $1 back.
Right.
And I can't really touch it.
100%.
Yeah.
So the way that venture capital funds work is you're a 10-year fund plus usually 2 extension years. So think a 12-year fund. Mirror that to our discussion about alignment. Mirror that to the length of time it takes to grow a business and actually take that business to a scale that will generate the return necessary for that venture capital fund manager to return that $1 for $10 back to their limited partners. So there's I'm going to say it this way, there is a misalignment of interest often that is not talked about, that needs to be talked about when that first check goes in. And that is, from a venture capital perspective, we are looking to invest in your company, partner with you, which means we're married for the next 10 years. 15 is around the right time frame these days. Maybe that's going to accelerate because of artificial intelligence and the speed at which new company creation is taking place. But let's just say, for the sake of argument, it's a 15-year term. I'm going to be married to you for the next 15 years, but I know that my limited partners, so my investors, need to get their money back in 7 years or 10 years at the top. So now I have to artificially work with you to say, hey, can you speed up your exit? We need to find you a home. We need to get a good valuation and a good multiple, because I need to return capital back to my investors so that they put more money into my next fund and my next fund and my next fund. So without going into the whole BDC thing, because remember that BDC as a fund of funds investor is also invested in directly and indirectly in many companies in Canada. I think their portfolio is somewhere around 450 companies in the country. Those VC funds that they are also invested in are marking up or down those same companies. So when you do the math, oftentimes, and this was certainly true for me when I was doing fund of funds and direct, we would have to square up whether or not a certain fund we were co-invested with in the same company was giving the same markup or write down to that specific portfolio company. That's what gets everybody all screwy. And that's when all the arguments start to happen. So, I mean, I don't know if that's making any sense to you, but that's sort of how it works. And so if we think about policy and the $750 million bun fight that's happening with respect to early versus late stage, I think the crux of the issue is alignment of interest between entrepreneurs, let's put angels in there too, entrepreneurs, angel investors, venture capital investors through exit, so that there is alignment of interest. And if you're building a company in Canada and you want to go a different route, you want to make it organic or grow it to be $100 million plus, and there's 77 roughly of those in the country right now are at $100 million plus revenue run rate, then you need to be having those conversations at the get-go. And aligning those interests, and we can talk about the policy stuff afterwards. But alignment of interest is going to be, it frankly is everything when you're making investments in this space.
Yeah, Graeme, you talked about alignment of interest. Augur VC has not taken government money, and by purpose. Is there a reason why you haven't? And what do you think happens when you do as a VC?
Yes, this is, I think, one of the core issues that you see in Canada right now is this proliferation of government as LP or government as co-investor. So the original idea, like stripping away the name, like, oh, venture capital, like going back to investing 101, buy low, sell high. You look back in history, and the idea of venture investing has been, I'm going to front you money, and if you succeed, I take a cut of it. The basic incentive there is to convert distributions to carry. Now, there's all sorts of other reasons people do it, but like that's the core motive, or it should be, because that aligns incentives. There's management fees as well.
Can I stop you? Explain distribution to carry.
Sure, yeah. So if a company is successful, if they exit, like Michelle's talking about, the fund will get, its portion of that exit. The LPs get their capital back plus, the remainder of the multiple, less an amount called the carry, which goes to the manager. That's the way you make lots of money in venture capital, is by converting distributions to carry. Yeah, it's your profit, exactly. The issue that you see is that that alignment of incentives can break when government comes along and says, hey, I'd like to be an LP in your fund. Fund manager says, okay, sure. What do you need me to do? Well, instead of trying to just seek profit, I want you to invest in this region, or I want you to invest in this group, or you're only allowed to do deals that look like this. Here's a big long checklist of things you have to show me for every deal that you do. And you have to report on, did you comply not with winning the best allocations that are most likely to profit, but instead on meeting my checklist objectives, because that's my policy goal. I've got some industrial policy. Space is a big one. Defense is a big one right now. You better go invest in those if you want me to keep giving you money. And then the manager says, well, I can take a management fee off of that money, whether I'm successful or not. So, okay, I'll go run around and just do what you want instead of trying to just seek profit at all costs. The problem is that people get addicted to management fees. Tony Fish, who's like a 30-year VC, somebody who I have a lot of time for, he recently wrote that management fees are like heroin. Once you get addicted to them, it's impossible to stop. And so you see these big fund of funds, you see these big funds out east especially, where they've gotten so much money since the early 2010s and even before that out of government, that they've become more of like a grant writing agency in disguise, as opposed to a traditional venture investor seeking to convert distributions into profits. This breaks the mechanism of venture because it's no longer about making money. It's now about how can I find a company in like Atlantic Canada that's doing space that has founders that look like this. And if I happen to find one, well, I've got more of an incentive to back them regardless than to determine, is that actually something good to invest in?
Yeah. Derrick, yeah, feel free to add. Yeah.
Well, first, I just want to violently agree with everything Graeme just said. I mean, this was actually one of the points that I put out a couple of weeks ago. And, you know, when I was researching that piece, I realized that there's vanishingly few venture managers in Canada that are ever going to reach their carry. It's less than 10%. It's a tiny number. And so if you think about it, how do the GPs get compensated? They get their rake, they get their 2% of AUM every year, and then in theory they get their carry if they hit a hurdle, which is usually around 8%. Almost none of them will hit 8%. And so once you know you'll never hit 8%, you're just in the business for the rake. And if you're just in the business for the rake, you don't have an incentive to sell anything ever, because if you sell it, your AUM is down and your rake drops. So your incentives are all completely backwards. But I also want to touch on something that Cam said that I very much agree with. And I worry in Canada that we're blurring the lines, because we've got, some years, the VC, the government-funded VC is such a huge percentage of the overall capital that's being put into the place that I really wonder if we're blurring the lines between economic development and financial return. And there's absolutely a role to play in government for economic development. I sit on the board of AEC. Our mandate legislatively says it's an economic development organization. And I will argue that it's done, it's checked every box in the 16 years it's been alive. It's done a lot of really good things from an economic development perspective, which is exactly its role.
Which is like job creation.
It's building a VC industry. We've got VCs here. We've got, I think it's something like 400 companies. No, it can't be that many. A lot of companies that got investments. There's thousands of people employed in these companies, the outside capital that attracted. From a taxpayer's point of view, it's a win across the board. There is no negative at all. And, all the money that was invested is still there and more. So, it's done its job from from an economic development perspective. And I'm sure when they set it up, I wasn't there in 2009, but they probably expected to get venture type returns. And what they got was venture type returns, but they weren't the 15 to 20% everyone was expecting. They're much more sort of prosaic, because that's what the Canadian industry has produced. And so it's fine for certain organizations to say, if that's their mandate, that return is adequate. But if I'm going to invest my own money, I'm not doing it for 5 or 6% that I collect in 15 years, and then I pay capital gains tax on the nominal gain. Like, give me a break. I'll buy RBC and I'll clip the dividend every quarter, right? And pay a lower rate of tax. So, the whole thing is backwards. And what Graeme was just saying about, once you have entities that say they're venture, but you got to invest in this region, you got to invest in this class of citizen, when there's all these restrictions, it's not venture anymore. And I really worry that's economic development. And I think we've confused the two in this country, and that's why we're on a bad track.
Yeah. Cam, do you want to hop in there? And Cam, I also want to talk about your role at Flightpath, because you guys did, you and Ken Bautista up in Edmonton said, hey, we're going to go to some private capital in Edmonton, raise $500,000 and deploy that. And some of those companies are crushing it, but that was just like private capital that you guys deployed. So I'm curious from your take, as having done it from Flightpath VC side, to kind of having an outside view, what your perspective is.
Yeah, so I guess maybe two things. One, quick kind of piece on that, because I think AEC, one of the reasons that it's done well is that it said, okay, we're willing to take a little bit less on the return side, but what goes into funds, there isn't restricted funding going into that. You guys are LPs. The only restriction is that you have to have a partner in Alberta. Correct. And there might be a little bit of so you haven't put any money into Alberta, might not, be looking at going into your next fund if there's nothing here, but there's not we're expecting to have all of our dollars deployed here or anything like that.
There's zero direction. You only need a partner on the
here,
ground.
Yeah.
And other than that, it's unconstrained. But I don't think I would say that we expect to take less. We expect to get industry returns, beta returns.
Yeah, for sure. And so I think that that is a difference between most programs that that you're talking about that go, okay, well, I want this money deployed in Canada, or I want this money deployed in my region. Like, if, as much as I love every entrepreneur in Alberta, if I were to start an Alberta fund, your returns would be less than a fund that could invest anywhere in the world. Like, that's just, you're artificially constraining your market, and you're probably going to have lower returns because of it. Like, right?
I actually don't think that's true. I hear a lot of people say, because we invest in a lot of Alberta companies, and our returns are, we're not knocking the cover off the ball, but they're certainly sufficient for the risk we take. So I actually believe there's investable companies in Alberta. We found a lot of them. I think that it's been tougher recently because the high valuations haven't really reset. But, we actually have quite a few exits under our belt. Why is it that the VCs don't? I think it's because their incentives are all wrong.
So I agree with that. And to be clear, I think there's a lot of incredible deals in Alberta. There isn't, I insulted the room. This is awesome. Off to a great start here.
What we're here for.
Yeah. Somebody need to disagree. No, but like, anytime you artificially constrain a fund in some way, you're probably going to have worse returns. And so the government coming in as an LP and saying, this is great, we're going to compare you to Fund A that can invest in the best deal it finds anywhere, and you can only invest in my backyard, you're probably going to end up with worse returns, or you're setting up the grounds to have worse returns because of it. And so we kind of, like, as an example, we did that. So we raised a small fund, this is like a decade ago, in Edmonton. The whole thesis was, at the time we had started Edmonton, this is great, but like, nobody's writing a $25,000, like, just get going, try and see if this works. Here's kind of like enough money to live off ramen and, hire a little bit of people for 3 months, just go. So kind of nobody was writing a check in the city at the time. We felt like that was a blocker. We went to a number of folks in town who either had exited tech or exited something else or made money in real estate or something, and said, hey, we want to do this to try and help, grow the community here, and maybe we'll end up making money off of this. But we did say, like, look, if we were able to write a check anywhere in the world, and that was how we deployed this fund, the returns would be higher than just writing checks to just companies we're seeing at just this stage in just this city. And so it was great. Like, we're happy with we've had a couple exits out of the fund. We're like, in the money, so to speak. And we have a number of companies like Drug Bank and Samdesk and Vertical City and other ones that hopefully will exit along the way here. And, kind of hit like that dual piece of being able to, see a return and also, spur some economic activity at the time. But again, like, we were upfront with our LPs about what the risk profile and what the potential returns because of that were going to be. But then at that point, it was just invest in great companies in Edmonton.
Yeah, Michelle.
Can I just jump in for a sec? So practically speaking, there are funds that are regionally focused that do really well. I mean, Intergen, Sandy's at the back. Intergen has done very, very well with their first fund, and Fund 2's en route. So I think it can work at the regional level. It can also work at the Canada level. Where you run into problems is when you do go global and you don't have the people on the boots on the ground in order to be able to figure that out. And one of the issues I think we also have here is our talent pool. I'm going to offend a few VCs, sorry. That's okay, they all know me. We have a talent problem in venture capital. And when we look at Derrick and Graeme, Cam, a bunch of people in the room, a lot of these folks are entrepreneurs, they're operators, they understand what it means to actually build a business, to manage a P&L, to deal with customers and CS when shit's going sideways. And that's not a policy thing, that's a practical thing that you have to do in order to get the returns that you want in this asset class. And that means you have to be close to your customer. And in venture capital, the customer is you guys, the entrepreneurs. So there's an intrinsic thing that has to happen there. From a policy perspective, if we think about the government dollars that are, I'll say, flooding the market right now, I think the question really is, where is that money going? And is it going into companies? Is it going into funds with the right talent pools that will then be able to deploy that capital and steward it appropriately with the entrepreneurs that can then generate the returns or not? And I think that's a question that I don't believe anybody's answered yet.
Yeah.
Yeah.
Graeme.
I just want to build on that. No, I'm just going to dig in. I'm just going to go further. Key point here. I know lots of venture managers in Canada. I'm sure everybody here knows lots of venture managers in Canada. If you're in San Francisco and you have the opportunity to be so lucky to be talking to the founder of a company that's a very hot company, you basically have to make a decision immediately as to whether you want to invest or not. Like, we do the deal in like a day. We've done a deal in like 30 minutes before. The reason for that isn't like, oh, I get excited and so I'm just going to jump on it. The reason is that there's like 50,000 other people trying to get into that deal at the same time as you. You come up here, and one of the things I've noticed is that there's pretty strong skill issues in the venture allocator community in Canada, where one, simply because there's like a shortage of capital, to Derrick's point, or at least a shortage of organized capital, they feel like they've got the luxury of treating the founder like, you'd be so lucky as to even get a phone call with me. And I'm sure a lot of you guys, if you're founders out there, you've felt that before, where like you have to chase them as opposed to them coming after you. Number two, probably even worse, there's a belief that there's a luxury of underwriting time where you can take 4 weeks, 6 weeks, 8 weeks, 12 weeks, however long you want. It doesn't really matter, and that it's to the prejudice of the business when you do that, right? So this difference in norms and pace of play in Canada is one of the biggest issues that I've seen that hurts founders. To your point, it's purely a skill issue. It's because people don't know what they want, and they're more concerned about, I want to preserve the management fee gravy train, so I better check all the boxes. That conservativeness ends up turning into a death spiral where you're more conservative, your returns get worse, you get more worried about your LPs leaving you, and therefore your management fees leaving, so you become more conservative again. That's one of the biggest issues in venture today, I think.
Yeah, and even if there's not like a formal checklist that you've agreed to when taking some of this like BDC money and money like that, sometimes it's like tacitly agreed, right? Like, oh, these are the funds that BDC is or these are the companies that BDC is investing in. We're the largest direct investor. You should look at these and really consider them and follow us to do due diligence. Yeah. But and so you should only be invested in these, kind of like wink, wink, right? Are you seeing some of that stuff where that's also a reason why people get more conservative?
Yeah, there's a tremendous amount of political influence in venture in Canada as a result of all of the money being derived from political sources to begin with. Policy alignment and industrial policy in particular, which you're seeing right now, people line up against that and they put on branding against it, and they, hire people who have talent sets against whatever industry, defense, rocketry, pick your poison. All of this stuff is to play a game that is not venture capital. It's a game of politics.
Yeah. All right. I want to move on to the nonprofit ecosystem supports. If we've had our fill with VC, I'm sure when we open up to audience Q&A, we can jump back to this topic. But Cam, last time I looked, there are 400 accelerators and incubators in Canada. It was something like the top 3 cities in the world for incubators were Toronto, Tel Aviv, Montreal, Vancouver, and then like Boston, New York. In terms of like each one's with like 40, and so I guess my question is like, Amy, again, I already gave you your sugar that. Amy might be one of the best sort of ecosystem supports, but like when you look at the full gambit, running 400, quite possibly the most per capita in the world, and yet not necessarily having the best outcomes. Which ones are good? Which ones should founders participate in? And maybe not, but where do we draw the line? And so many of them are funded by different institutions. We don't even know how many actually get government funding, and none of them take equity. I think the top 7 don't take equity in the companies. And so aren't necessarily motivated like YC does. It looks like a good thing that they don't take any equity, but because they don't, they're not necessarily motivated. So yeah, I'm curious, how is the system set up, and do you think it's working?
Yeah, awesome. I'm the one who's. What are the good ones and what are the bad ones? Awesome.
Let's do it.
I just insulted.
Let's name names.
I think I just already pissed off the room. Don't make it worse. No, so. I'm surprised it's 400. I'm surprised it's not more. A friend of mine led innovation in BC. At one point, she counted, and it was like 100 plus accelerators just in BC.
Wow.
And so like it's kind of wild. I think when you look at the best ones, I'll just go back to this piece around alignment. Like we break alignment on a ton of things. The reason, again, accelerators as they are typically done in the US are, I am putting my time and a small amount of money into it, and I succeed when you succeed. So YC puts in money, they get a part of your company, and then they ultimately are successful when you exit and they get a return from that. Most things in Canada that we call accelerators aren't actually set up that way. So we'll have a whole bunch of accelerators. They're all programmed, so they all mimic what's going on in YC. So they're like, well, there's dinners, so we'll run dinners. And then there's like there's classes, so we'll run classes and these types of things. So they mimic all the things around it, but don't actually have alignment. And then it is tough because you're like, okay, in order to do this, I need to get the government to fund me to do it. They're going to ask what percentage of the companies are still alive a year after they went through your program, so I can compare it to something else, and it's probably the wrong metric to compare it against. And then we're just in a massive misalignment problem. So as far as what's good, I think the best ones are either something that have alignment in some way, and that can be a program that's like co-funded, like the government's putting in money and the company's putting in money, and the reason for that is the company has to see value. They'd be like, we're not going to put money into this. Or the investor's putting in money and they only see a return when the company makes money off of it. These types of things. So I think the best programs create the best alignment between the startup, the entrepreneur, and the program itself and the outcome. And most of our programs aren't set up around that.
Right. And there's the other thing. We'll get to audience Q&A, so I'll let you jump in. But I think the other thing that's interesting is like sometimes to the tune of like millions of dollars these accelerators and incubators are getting annually, and oftentimes, like in Calgary, we can probably name 10 or 15 that get money from the government that only survive because of money from the government that they get. But they only get refunding, both federally and provincially and municipally sometimes, based on their own impact reports. And their own impact reports are based on job creation and revenue creation. But each one will claim the jobs and revenue from companies that they barely touch, right? I used to work at Skip the Dishes, and when we sold to Just Eat, you have no idea the people who we'd never talked to were like, oh, they sat in our office space for a month. That was us. That means that we should keep getting more money.
Success has many fathers, failure's a bastard.
Yeah, that's right. Yeah, exactly. That's success is many success is many fathers and failure is a bastard. Yeah, that's a great line of like, and we also to claim it in order to continue to get funding and continue to live. I mean, Graeme, I want to hand it over to you. Maybe again back to a similar sort of format of question. If your portfolio companies are considering going through them, like CDL specifically, some of these companies are thinking about raising funds to support their companies. What's your take on some of these nonprofits?
I think that the biggest thing that you have to be aware of if you're going to do something like that is to look at the success rate or the failure rate of the incubator or the accelerator going into it. So if you look at CDL, I love CDL, but if you look at their unicorn production rate, it's like 20x worse than market average. And so they're producing way fewer successes than like, if I was just an investor throwing darts at a dartboard, I'd do better than if I indexed all of their companies. Now you can say like, oh, well, that's not the point of it. But like, as an investor, that is the point of it. Any kind of accelerator that you go into, if you check how's it done, like Y Combinator's produced over $1 trillion worth of companies. Incidentally, two of the people who founded that, both Gary Tan, who's the current president, he came out of Winnipeg, and one of the original Winnipeg, Peg City. One of the original founders was a guy, Trevor Blackwell, and he's from Saskatoon, Saskatchewan. So if you got any Saskatchewan people in the house, know that we're still representing down in San Francisco. But the point is that like you can look at the success rates of these organizations, and you can say, as a startup, like if I'm high potential, is this going to help me or not? The best way to look at that is the track record, like anything.
Can I jump in?
Yeah, please.
So, I've been a fellow at CDL Rockies since day one. And, it's interesting because I think it actually plays, so at least when it got off the ground, I mean, it was all privately funded. I was one of the original funders. And there's like 12 of us that all committed, $100,000 a year. And the point of it is you're mentoring companies, and there was no government money at all. And the slogan is build something massive, and you're right, there haven't exactly been a ton of unicorns. But if you do look at, I can't speak, I think they've grown too far, too fast. Yeah. They've spread themselves like a mile wide and an inch deep, because I think the model is solid, privately financed, private sector mentors. You walk into the room here in Calgary, and there's billions of investable dollars there, right? And people willing to write checks. And there have been some good outcomes. But I think systemically, they say that Calgary's the best site by far out of the 13 in the world, by far, for financial returns. And I'm sure that's true. And I ask myself, why is there 13? Why are they everywhere? They're in Wisconsin, they're in Oxford, I think they're in Melbourne. Like it's a bit insane. So I think there's actually, it's the only accelerator I'm really that familiar with, but I think there's elements of what they did that actually made a lot of sense. And it was that there was no government money at all at the beginning. And it was all investors driving the bus. And we're all committing quite a bit of our time over the course of a year to try and help some of these companies. But I'll tell you, the other thing is that this is my 9th year, and it really varies from year to year if it's worth my time, because it's the quality of the cohort. And you go, that's the rub. How did they pick the cohort? Because there's no institutional knowledge, because the turnover is so high, because all their employees get picked off, and they're not investors. So they're not really sure what to look for when you're picking an early stage, high potential tech company to bring forward. And some of them are just laughable that they get through. And some years there's just nobody that's any good. So I actually think that's the single biggest problem. And you get these freaking accelerator jumpers that just, they go all over the place. It's just wasting everybody's time.
Yeah. Michelle, I'm curious, just for you to weigh in quickly. Any sense of are we creating structurally better founders by putting them through these programs? Any thoughts on that? I know you don't necessarily have too much experience directly in that space, but curious if you want to weigh in.
Well, I actually do. I lived in Ottawa for 5 years, and I set up what is now Invest Ottawa.
Oh, okay, yeah.
And we started with a model whereby companies that got in had to be financed by the Capital Angel Network or another angel group before we would actually put them through a program. And so everybody had to have skin in the game or we wouldn't play. Now I think they've changed that model since. That was a long time ago. But that actually worked fairly well because we were all kind of like the YC model. We were all incentivized to participate. And the founders also had to put skin in the game, so we all were kind of in the club together. And that worked fairly well. I mean, those were like early Shopify days, like GAN systems. There was a bunch of companies that were in that sort of early formative, I'll call them the formative years. But to the CDL comment, I just want to play on that a little bit because I sat on the board of CDL Global for a long time. And the biggest conversation at the board level was always, where do we go next? Why are we going there? And how are we creating more quality coming out of CDL in each of the cohort areas? And frankly, who are the mentors that are going to support those companies, not just when they graduate from CDL super session, but when they continue to need 5 customers to support the business and actually get ready for a venture capital round of financing or some variation on the theme. So to answer your question directly, I think some of these programs and some of these organizations are thinking about it the right way. Yeah. But again, I go back to the alignment question. And if all of the organizations are getting their money from the same pots, and there's no discussion at the board levels of all of those organizations around how they're going to incentivize good behavior meaning we're going to generate economic development activity that ultimately translates into all of the entrepreneurs or the entrepreneurs that win getting to profitability, exits, and returning that capital back into the marketplace. That's my definition of economic development. It's not spread the peanut butter. It's how do we get entrepreneurial thinking out of the brain and into action so that we have the right people helping the right companies be successful. That's what generates the network effect and ultimately the flywheel, and that's what we need in the country.
do we need like an audit? Like where's like
Oh,
should we
yeah,
hire
100%.
KPMG to be like actually talk to founders and say what programs did you do, which ones were helpful, and stop funding the ones that aren't helpful?
I think so. I think NACO's done this already. Maybe
really?
maybe they haven't. Sandy, have they NACO done this already? Yeah.
Oh,
There-
okay.
So we
well,
need
let's
to,
get that report.
we
and
need to
let's
grab
cut
we need
all
to
the other
grab some of
ones.
that.
There's nothing more permanent than a temporary government program. Right?
That's right. That's pretty good.
100%.
Okay, how are you guys doing in the room? Have we insulted everyone, or you guys are all feeling good? Not even any nodding heads. Okay, awesome. So this is my last question. It's going to be for everyone, and it's you have 10 days. I don't know what's a good time frame. You have 10 days, as you have the magic wand. Your last name is Carney. What are you changing to improve the tech and innovation space across Canada? Or maybe your last name is Smith and you can just focus on Alberta, whatever you want to do. But what primary changes are you making from a policy perspective?
Oh, pick me. I've got the correct answer.
No, you're all going for it. Everyone's going for it. So yeah, Derrick, go for it.
So if I was Danielle Smith, I've told her this. The first thing you do is eliminate the provincial capital gains tax.
Yeah.
Eliminate it. Zero. And I don't care like why, because you only benefit if you're a taxpayer in Alberta, whether corporate or personal. There could not possibly be a bigger magnet to the world saying we're open for business with entrepreneurs. And I don't believe, so that is the simplest, and the capital gains tax produces about $400 million a year to the provincial budget, which is about $80 billion a year. So it's a trivial amount. But the message it sends, and if anyone in this room doesn't think you're going to get way more than that $400 million back by people and companies moving here, like it's so obvious and so simple, and they won't touch it. But you should all tell your MLA that that's exactly what they should do. And then the second thing, my name was Carney, is that the question is really, do you believe in the market's ability to allocate capital? Because that's what we don't do in this country. This is basically the thread of everything that we've talked about. And I would say, like, Carney strikes me as a guy where everything, he's a big institutional guy that went from, Goldman Sachs to the Bank of Canada, the Bank of England to Brookfield, like believing that they can, be a puppet master and sort of dictate everything. But if you believe in ground up entrepreneurship, and if you believe in free markets and capital flows going to where it's treated well, then you have to kind of reject that view of, the major projects office kind of thing and say, well, we got to be competitive. And, just to not put too fine a point on it, but I made the point that basically if you make $200,000 Canadian, you're pretty much within spitting distance of the highest marginal tax rate, which is higher than almost every state, right? And they don't get there until they make 7 times as much. And if you're, selling a company, what we have for the small business deduction on, lifetime capital gains exemption is pathetic. I mean, in the States, you can easily make 30 times that much tax-free if you have a successful exit. So it's time for us to say, if we want to be competitive, we got to start by having competitive rules, competitive tax rates. You got to encourage the entrepreneurs. I really think that a lot of entrepreneurs just start because they're here and they don't know any different. And then when they have success, then they realize the price that is extracted when you have an exit. And, like it comes later. But the investors understand this, right? And, capital is just the money, the income you've got left over after you paid your tax bill. And ours are so not even close to being competitive. And I really fear that nobody in Ottawa understands that that's like their solution is there's another $750 million and NACO and CVCA can fight over it. Like it's exactly the wrong answer.
Yeah, there's a new one too fighting over it too, I think, that just spun up yesterday. But yeah, Graeme, go for it.
So I think the biggest thing, I agree 100% on ditching Alberta capital gains, by the way. You hit the nail on the head there. That's the biggest thing we could do in Alberta. It would be a big lighthouse to not just entrepreneurs from across Canada, but even people from the States that like, oh, there's somebody here who wants to play. From a federal lens, one of the things that I think we could look at, and you could disagree with me on this or not, I think that we should pay the best students at the best universities to drop out and to instead go and be entrepreneurs.
Yes.
I think that if you took every person who's in the top 2 or 3% of schools, you said, here's $100,000 a year, I'll give you 2 years, go build something big. The economic growth that would come from that would be massive compared to, well, I completed my social studies degree. You're not going to see the same type of yield off of a culture that's highly institutional, to your point, that you will from one that's got real deep grassroots entrepreneurship behind it. We need to culturally reinforce and incept into the minds of young people. Not only is breaking the rules to win good, it's kind of the only way we can win as a nation.
A Teal Fellowship in Canada. It should be the Hunter Fellowship.
Well, we already give enough money. I guess.
Yeah, Michelle, go for it.
Derrick's going to be giving a lot more money soon. Look, I agree with everything that Derrick said with respect to tax exemptions, but I also think that it starts at home. And regardless of, I think we need to talk to our MLAs and the governments, et cetera, about what can be done. But at the end of the day, the only way we're going to get ahead is if we can compete. And we have all of the tools and the resources here, but we need to get off our butts and start doing it. And that means letting the capital market, letting the markets decide to a greater degree, being more competitive with US counterparts, which means going down and seeing what they're doing, coming back up here, taking those best practices and putting them into play. Because I just don't think we're going to get there if we're all very nice people, which we all are, but we're navel gazing. And we're actually going to miss the boat. And the government is going to be focused on trade and tariffs and more trade and more tariffs and all of the jazz. But that's, to me, that's just shiny object chasing. That's sort of like the red herring, look over here, while we're missing the big opportunities. We've got tons of, even in Alberta, I came back here because we have a huge amount of talent and resources in this province. And I just think we're underutilizing ourselves. So I think we need to get organized, let the government do what the government's going to do, and just go get it and stop waiting for permission and start asking for forgiveness.
Yeah, absolutely. Cam.
All right, so I have 10 days and a magic wand to fix entrepreneurship or startups in Canada or venture in Canada.
That's right.
All right. So yeah. Okay, so I think there's 3 things I would change. So one, we haven't talked about this enough tonight, but like one huge problem in Canada, the biggest source of funding that every startup should want is customers. And we're terrible at being customers of Canadian startups.
Absolutely.
We're terrible as the government of it. And we're terrible as corporate Canada, so you don't just get to point your finger at the government on it. I actually think it's a bigger problem in Canada. We end up having a lot of startups leave, not because they couldn't find their first check here, which is a problem, but even more because if all of my capital and all of my customers are south of the border, and then I've now hired most of my team south of the border, why would I stay north of the border? And then I lost like all my ability to get shred and any other advantage up here. So okay, see you later. So to me, customers would be a big one. Fixing procurement in Canada, I guess, is a quest, but I have a magic wand. So I fix procurement 14%. I think CCI had this out there. 14% of Canadian GDP is Canadian procurement. So we stop being biased against Canadian companies and stop sole sourcing to like our American competitors. Then are like Canadian companies who are better than their American competitors, but have that money and those contracts flow south of the border. I think you'd actually fix almost all this. So that'd be one big one. I would take all the venture dollars that we are deploying and I would deploy it into fund managers across Canada. So just let the market decide on that one, put it into people. And like, let's take some bets on early stage fund managers so they learn, see which ones win, see which ones don't, and we'll keep investing in the ones that win and not investing in the ones that don't. So that's probably how I would fix venture. And then all of our programs, I would try to be aligned so that they would have to be a co-investment of some sort. So either it's a grant that goes in or a co-funding that goes in, or the company has to pay if they're going to have the government pay for part of a program. That's what I would do in 10 days.
Yeah, okay, that's awesome.
Or just do Derrick's taxing and then.
That's right. My take is like, if I had a magic wand, I would just convince all founders to like understand there's a tier 2 way of building a company, which is government-funded venture capital programs and grants, and there's a tier 1 way, which is talk to customers. And I would convince all founders, hey, forget everything you've learned about tier 2 and just do tier 1, like some incredible, like the most, I think, exciting Calgary companies I'm seeing right now come up. But that's my take, and you guys don't give a shit about me. Give it up for these guys.
I agree. Do what Philip said. Never mind what Derrick said. Do what Philip said.
Yeah, awesome. Guys, I want to open it up to you guys. Are there any people here who have questions? Yeah, all right.
Forgive me, Derrick, I came a little bit late. So you would know, obviously, being on the board of AEC, that the legislation is potentially being changed so that AEC can be a co-investor, Alberta Innovates can be a co-investor. You alluded to it with your comment around the capital gains, but if that starts to crowd out more capital, they don't have the same, let's say, constraints as a typical VC would. What are other ways to crowd in capital? How can, to your point, we get more private capital allocators making the decisions and almost, to a sense, counterbalancing what I would consider government overreach?
Yeah, well, George, I think, so I just got back in the country last night. I haven't, not really up to speed on what was announced, but there's no additional money. I'm not sure that this is really that big a deal. I think it could be a nothing burger. I have to be convinced. But to your question about crowding in more private capital, you know, it's a great question. Like, as you know, I think you've seen my presentation about like our methodology. Why do we do it? And my message is, if you're a high net worth investor, you should invest in the startup space because, you know, entrepreneurs obviously need support, but it's not a philanthropic undertaking. We do it on a for-profit basis, and you know, we're pretty disciplined, and you know, we're pretty rigorous about, you know, valuation terms and that sort of thing. But we've written a lot of checks. And what I found is that most people that are capable of doing this just don't want to break a sweat. They don't want to do the work. They don't want to treat it like a business unit. And that's fine because it is a bit of work. But, you know, I would argue that it's an uncorrelated asset class and you should have some modest exposure if you're an investor. The challenge is finding good teams of venture, like general partners, that can actually manage and produce excellent returns. And I think that we've covered some of the reasons why historically it's been pretty bad in Canada. You know, the long-term 25-year average, according to, or average, you know, median return according to BDC is like 5%. It's like, like that's nominal and pre-tax, right? So do the math. And if you look at the Vicky numbers, they're terrible, right? It's just been, you know, there's a few outliers and then just a lot of garbage. And you go, well, why is that? And I think the answer is a couple of things. One is that with a few exceptions, I don't think GPs have enough skin in the game. They need to have better alignment so that they feel the same pain that the LP does when it's not a 10-year fund, it's a 17-year fund. And I think that the biggest problem is that the underwriting is poor. And you go, why is it so bad? Like, why do we the vast majority of deals we turn down is because of the underwriting, because we don't lead rounds, so we just look at the terms. And I would say 80% of the time, it's the underwriting. And if you think about it, if the underwriting is 2 times too expensive, then your return is half of what it should have been, right? And I think if you see an opportunity that looks really exciting, it's very easy to say, well, you know, if this is a unicorn, it doesn't matter valuation because we're going to make a pile. And if it's a zero, it doesn't really matter because we're going to lose it all. But the truth is that in Canada, almost all of them are in the middle. There's not that many unicorns, right? And there aren't really, you know, there's a lot of kind of Walking Dead, or what we've learned is there's a lot of 3X, 5X, you know, 8X good companies, but they're not, you know, 20X or 50X. And I don't think investors are underwriting for, you know, a median 3X to 5X. And
quickly, what do you think about flow-through shares for tech as we've seen in energy and mining?
yeah, so I know quite a bit about, I've started 2 companies on flow-through shares. And so I think the problem with flow-through, everyone throws it out, like there's no reason in my opinion that you couldn't do it in tech, but there's a thing that the tech world in Canada has that the resource world doesn't, which is shred. And by having shred, the government is basically saying we're rebating, especially smaller companies, we're actually rebating, you know, the money just kind of like a flow through. So I don't see how the government could ever let you have both. Yeah. So I think that I could see a scenario where you got to pick one or the other, but either way, spread's essentially a flow through because they're flowing back 35%. In Quebec, it's like 55% of your expenses. So I don't think they can coexist probably in the real world. I don't know.
Hi, guys. So I enjoyed that. Thanks for the presentation from the family office, venture capital, alt finance point of view. One of my questions is concerning more Tech Thursday, though, because a lot of the companies here are pre-seed and seed. And there's been a lot of shifts in the federal government, obviously, with our policies regarding now where we're trading and where that's being incentivized. And I guess from your guys' perspective, how is this incentivizing groups that are in kind of the more early stage of development to be successful in order to develop the future economy, which seems like it's very infrastructural focused?
Yeah, I can start on this. I think that pre-seed and seed investing, like we do a lot of pre-seed checks. We've been the first check in 9 companies. And except for one, they've all done really well. When you invest at pre-seed, if you're doing it at the absolute peak of the game right now, you're not really underwriting a thesis so much as you're underwriting people and their vision. That's just a function of, the best companies pivot. Like Twitter didn't start as Twitter. Twitter was a video game company, and they built an internal tool to communicate with each other. They ran out of money, and they said, well, maybe somebody will want this. Generally speaking, if you're looking for direction from the government as a pre-seed company, you're probably toast. Like you're probably not going to get anywhere on a thesis. And that's just because there's not reliable signal there. Like you can hear the narrative of I'll give you a good example right now, defense in Canada. Oh, there's this huge demand for defense. And did you know the feds are going to spend so much? And all these funds came up out of nowhere overnight that are doing pre-seed and seed stage defense investing. The reality is that if you're starting a company and you're not already in the inside of that, you don't already have access to all of those people, you're not going to be able to raise funds effectively without customers. So, going after customers is much, much more important. Whatever kind of crazy, stupid passion you've got. Like we've underwritten people who are so fucking weird, and we do it because they're weird and because they're obsessed with some stupid thing that nobody else has ever been obsessed with before. You can watch hundreds of millions of dollars of revenue pour in on that kind of obsession. So I guess the basic advice I'd give would be don't try and tie your thesis to any kind of policy wind. Those come and go. Find something that you are nuts about and just run off into the desert by yourself.
Awesome. We're going to cut to 2 more questions. Any more questions back here? We got Dan for sure, but any more? No one? I got a statement. You got a statement? No statements. Any questions? I'm actually looking for if a woman wants to ask a question. Yes. All right.
When you guys were talking about how there's kind of like a culture in the city where entrepreneurs are kind of looking to kind of get your attention, and you said that it should be the other way around. Can you elaborate a little bit more on that?
Yeah, so one of my friends from San Francisco, his name's Dan Preston. He started a company called Metro Mile, and his slogan that he's got about VCs is when you're building a good company, they work for you and not the other way around. I think that's really true in terms of when there's a functioning market. That's what it looks like, because there's a lot more capital in this world than there are really, really high quality deals to put it into. The challenge is, of course, in Canada, it's not an efficient market. There's a lot of gaps. People don't know what deals exist. There aren't word of mouth networks. There's not you can't go to the coffee shop and be like, hey, how did you exit your last company? There's not that kind of density of knowledge here. So it ends up not being as easy for the average Canadian entrepreneur to find that. If you want to do it, again, I'll just beat on a horse I've been beating on all evening. Revenue, go out and sell something where you can grow your revenue quickly, and you can show people that, you don't know me from a hole in the wall, but I'll tell you, I can sell things to people really well. And if you can sell things, money will come and follow you.
Yeah.
You have optionality. Yeah, and you have optionality.
Last question here to Dan.
I have 2 questions, but I can probably make them yes, no. So quantity and quality. One is is quantity, which is if you were investing in a company, you through your funds, you as an individual, and you look at the cap table, and the cap table is 80% government of Canada, government of X, and funds that are essentially grant enabled organizations, do you take that cap table seriously as a seed round, as a Series A?
I'm going to go with no. Those are the choices. I can't recall actually ever really seeing that. I think we're kind of post-love money pre-Series A type investors, and generally we're there with, private money for the most part.
I think it depends on, frankly, who those people are. So I would be looking under the hood to see, who in the which government fund is it, and who is the person. The ecosystem's small; it's not very big, right? So I'd be looking at who, and then from there making a decision as to whether or not I went down that road. Because particularly at that stage, as I would be thinking not just this round of financing, but 2 rounds of financing beyond that. So who are the people that are going to support the company 2 rounds from now? And are any of those people within those groups? If not, then what would I need to do as an individual or as a VC fund in order to galvanize and syndicate the next round of financing? And is that going to be a liability? That would be how it sounds complicated, but I'd be looking at the people, because when the shit hits the fan, which it will with the company, who's around the table as the investors to support you and the team to get to that next inflection point. And that's why the people matter so much.
I mean, hopefully you're not at a seed stage and 80% of your company's owned by someone else. But like if 80% of your investors are, I don't know. I mean, if the company's doing well and they just ended up taking money or had to take money from, that's all they could get investment from early on, and now they're doing incredible, then they're doing incredible now. I probably more, the one thing is like, you'd want to look at what terms are with that money. And at times, sometimes government checks come in with other terms that can be more difficult. So that would actually concern me more, like whether it's board rights or future non-dilutive clauses or all these kind of funny things that start to seep in there. Then if they're doing great and I wanted to make an investment, that would be more my concern than who their initial investors were.
I agree generally.
I guess really quickly, is there a lack, or is there too much generalist VC versus niche VC in Canada?
I've got a comment on this one. I don't like to talk too much, but I'll answer this question. Venture capital in general is an asset class. Like if you zoom out from Canada and you look at the States and you look at Europe and you look at everywhere, it's undergoing a big change right now. Like the malaise that we've been talking about isn't just Canada specific. It's like private capital all over the world is being like, this asset class didn't really meet up to what I was hoping it would. You're seeing insane concentration into certain verticals right now. So like last quarter in the US was the biggest quarter for venture capital ever by about 6x. Like 90% of it went into AI, both on the infrastructure side and the application side. That concentration, the reason people are doing that is because they're saying like, that's where I think the money is going to get made. So if you're running around and you're being like, no, I'm going to underwrite, some random SaaS company that's like a Figma knockoff, you're going to run into problems, I think. And I don't think you're going to find a lot of love. I think that in Canada, we've got some interesting flywheels here that historically haven't gotten a ton of love out of venture capital land. Those flywheels, especially ag, which is one we were talking about the other day, I think, you're seeing a ton of interest spin up around that. And it's very organic. Like it's not being forced. I think that you're going to see more specialized capital form around all sorts of Canadian flywheels.
I think overall, and this also maybe gets to your question as well, like more competition in Canada in venture would be great. And you have to come in with what's your thesis and what's your competitive advantage versus just like, I'm one of the few people with money in Canada writing checks. And so this, maybe I'll back up what I said about regional funds earlier. If you have some competitive advantage around like deal flow regionally or deal flow in a specific vertical or anything like that, like I think like funds built around what your competitive advantage to get better deals are, we should see more of in Canada. I don't think we're seeing enough of. I think because of that, we're not seeing enough smaller firms. And then what gets to some of the like structural things in Canada, funds are moving upstream because they can write checks that are slightly less risky in bigger funds and get more of a management fee, which is kind of hitting the sweet spot of everything we've been talking about earlier. And that I do think that's leaving a little bit of the seed, especially pre-seed, behind in Canada.
Sweet. Okay, that's it. Maybe one more time for these guys. Yeah. Thank you guys so much. I'm going to put the music back on. You guys are, the bar's still open. Grab a drink, mingle. Feel free to ask these folks more questions. And yeah, thank you guys so much for coming up.